Hi, welcome to week 7. This week we're going to be talking about accounting. So I'm going to go ahead and pull up my PowerPoint to talk to you guys about accounting. Okay, so management and accounting information. How can information reduce risk when making a decision? Information is one of the 4 major resources, along with material, human, and financial, that managers must have to operate a business. Information helps managers reduce risk while making decisions. To improve a decision-making process and reduce risk, the information used by individuals and business firms must be relevant or useful to meet a specific need. Better intelligence and knowledge that lead to better decisions are especially important because they can provide a competitive edge and improve a firm's profits. Theoretically, with accurate and complete information, there is no risk whatsoever. On the other hand, a decision made without any information is a gamble. For the most part, business decision makers see themselves located somewhere between the 2 extremes. As illustrated in this figure below, when the amount of available information is high, there is less risk. And when the amount of available information is low, there is more risk. Information, when understood properly, produces knowledge and empowers managers and employees to make better decisions. An information rule emerges when research confirms the same results each time that it studies the same or a similar set of circumstances. Business people try to accumulate information rules to shorten the time that they spend actually analyzing different choices. So information rules are the great simplifiers for all decision makers. Business research is constantly looking for new rules that can be put to good use and looking to discredit the old rules that are no longer valid. The difference between data and information is that many people use the word data and information interchangeably, but they differ in 2 important ways. Data are numerical or verbal descriptions that usually result from some sort of measurement. Information is data presented in a form that is useful for a specific purpose. For a manager, information presented in a practical, useful form, such as a graph, simplifies the decision-making process. The average company maintains a great deal of data that can be transformed into information. A database is a single collection of data and information stored in one place that can be used by people throughout the organization to make decisions. Although databases are important, the way that the data and the information are used is even more important and valuable to a firm. As a result, management information experts now use the term knowledge management, or KM, to describe a firm's procedures for generating, using, and sharing the data and information. So making smart decisions, 3 different software applications can actually help to improve and speed the decision-making process for people at different levels within an organization. A decision support system called a DSS is a type of software program that provides relevant data and information to help a firm's employees make decisions. It can also be used to determine the effect of changing different variables and to answer the what-if type questions. An expert system is a type of computer program that uses artificial intelligence to imitate a human's ability to think. An expert system uses a set of rules that analyze information supplied by a user about a particular activity or problem. Based on the information supplied, the expert system then provides recommendations or suggest specific actions in order to help make decisions. A management information system, MIS, is a system that provides managers and employees with the information that they need to perform their jobs as effectively as possible. The purpose of an MIS system is to distribute timely and useful information from both internal and external sources to the managers and employees that need it. A firm's information requirements are usually organized into 5 areas of management. finance, operations, marketing, human resources, and administration. Managers in each of these areas need specific information to make decisions. Financial managers must ensure that the firm's managers and employees, lenders and suppliers, stockholders and potential investors, and government agencies have the information that they need to measure the financial health of the firm. Operation managers are concerned with present and future sales levels, current inventory levels of work in process and in finished goods, and the availability and cost of the resources used to produce the products and services. Marketing managers need to have a detailed information about a firm's product and services and those that are offered by their competitors, including pricing strategies, new promotional campaigns, and products that competitors are testing that test marketing. Information concerning a firm's customers, current and projected market share, and new and pending legislation is also important. Human resource managers, what we talked about last week, must be aware of anything that pertains to a firm's employees, such as current wage levels and benefit packages, both within the firm and in firms that compete for valuable employees. Current legislation and court decisions that affect employment practices, and the firm's plans for growth, expansion, or any mergers. Administrative managers are responsible for the overall management of the organization. They are concerned with the coordination of information. Administrators must ensure that the information is used in a consistent manner throughout the firm. Administrative managers must make sure that all managers and employees are able to use information technology that is available and that they receive the skills training required to access the information. Administrative managers must commit the cost to updating the firm's MIS and providing additional training when necessary. MIS systems are tailored to the needs of the organization that it serves. In some firms, a tendency to save on initial costs may result in a system that's too small or overly simple. Such a system generally ends up serving only one or two levels of management or just a single department. Managers in the other departments have to give up on the system as they soon find that it cannot accept or process their data. Almost as bad is an MIS that is too large or too complex for an organization. Unused capacity and complexity increase the cost of owning and operating the system. A system that is difficult to use may not be used at all. To provide information, an MIS must perform 5 specific functions. It must collect data, store the data, update the data, process the data into information, and present the information to users. So in step 1, you collect the data. A firm's employees, with the help of an MIS system, must gather data needed to establish the firm's data bank. The data bank should include all past and current data that may be useful in managing the firm. The data entered into the system must be relevant to the needs of the firm managers. Perhaps most important, the data must be accurate. There are 2 data sources, internal and external. Typically, most of the data gathered for an MIS come from internal sources. The most common internal source of information are managers and employees, company records, and reports and minutes of meetings. External sources of data include customers, suppliers, bankers, trade and financial publication, industry conferences, online computer services, and firms that specialize in gathering marketing research for organizations. Whether the source of data is internal or external, it is good to remember the following cautions. The cost of obtaining data from external sources can be quite high. And although computers generally do not make mistakes, the people who use them can make errors or mistakes. So an MIS system must be capable of storing the data until they are needed. The method chosen to store the data depends on the size and needs of the organization. Small businesses may enter data and then store them directly on an employee's computer. Medium-sized to large businesses store data in a large computer system and provide access to employees through a computer network. An MIS system must be able to update the stored data regularly to ensure that the information presented to the managers and employees is accurate, complete, and up to date. The frequency in which data are updated depends on how fast they change and how often they are used. When it is vital to have current data, updating may occur as soon as the new data is available. Data and information may also be entered into a firm's data bank at certain intervals, like every 24 hours or weekly or monthly. Some data are used in the form in which they are stored. Data processing is the transformation of the data into a form that is useful for a specific purpose. Most business data are in the forms of numbers. Computers can be programmed to process large volumes of numbers very quickly. Their contents can be summarized through the use of statistics. A statistic is a measure that summarizes a particular characteristic of an entire group of numbers. An MIS system must be capable of presenting the information in a usable form and be appropriate for the information itself and for the uses to which it will be put. So then we look at business reports. So verbal information may be presented in a list or a paragraph form. A typical business report includes 4 parts. The introduction sets the stage for the remainder of the report, describes the problem that is to be studied, identifies the research techniques that were used, and previews the material that will be presented in the report. The body of the report describes the facts that were discovered in the process of completing the report. The conclusions are statements of facts that describe the findings of the report. And the recommendation section presents suggestions on how the problem might actually be solved. A visual display is a diagram that represents several items of information in a manner that makes comparisons easier. So there's several different types of display that you can use. You can use a chart, you can use a table, several different ways that you can present your information to your managers. Accounting is the process of systematically collecting, analyzing, and reporting financial information. Although accounting information can be used to answer questions about what has happened in the past, it can also be used to help make decisions about the future. To improve the accuracy of accounting information and financial statements, businesses rely on audits conducted by accountants employed by public accounting firms. So why is an audited financial statement important? An audit is an examination of a company's financial statements and the accounting practices that produce them. The purpose is to make sure that a firm's financial statements have been prepared in accordance with the generally accepted accounting principles, which is also known as the GAAP or GAAPs. GAAPs has been developed to provide an accepted set of guidelines and practices for U.S. companies reporting financial information and the accounting profession. The Financial Accounting Standards Board, which established the accounting standards for the U.S. companies, is working towards establishing a new set of standards that combines the GAAPs with the international financial reporting standards to create one set of accounting standards that can be used by both the U.S. and multinational firms. Without an audit function and GAAPs, there would be very little oversight or supervision, and the validity of a firm's financial statements and its accounting records would drop quickly. Firms would find it difficult to be able to obtain debt financing, acquire goods and services from suppliers, and find investor financing or prepare documents requested by government agencies. To help ensure that corporate financial information is accurate, Congress enacted the Sarbanes-Oxley Act in 2002. The key components include the following: that the Security and Exchange Commission is required to establish a full-time 5-member federal oversight board that will police the accounting industry. Chief executives and financial officers are required to certify periodic financial reports and are subject to criminal penalties for violations of security reporting requirements. Accounting firms are prohibited from providing many types of consulting services to the companies that they audit. And auditors must maintain financial documents and audit work papers for 5 years. Auditors, accountants, and employees can be imprisoned for up to 20 years for destroying financial documents and willful violations of security laws. While most people welcome the Sarbanes-Oxley Act, complex rules make compliance more expensive and time-consuming for corporate management and more difficult for accounting firms. Accounting is usually broken down into two broad categories, managerial and financial. Managerial accounting provides managers and employees with the information needed to make decisions about a firm's financing, investing, and operating activities. This is the type of accounting that you will take in the MBA program. Financial accounting generates financial statements and reports for people outside the organization, such as stockholders, financial analysts, banks, lenders, suppliers, government agencies, and other interested groups. Additional special areas of accounting include the following: cost accounting, which is determining the cost of producing specific products or services; tax accounting, which is planning tax strategy and preparing tax returns; and government accounting, which is providing basic accounting services to ensure that tax revenues are collected and used to meet the goals of state, local, and federal agencies. You also have nonprofit accounting, which helps nonprofit organizations to account for all their donations and expenditures that they may have. Accounting actually offers several different careers, and it can be a very exciting and rewarding career, one that offers a higher than average starting salary. To be successful in the accounting agency, employees must be responsible, honest, and ethical. You must have a strong background in financial management, and you must know how to use a computer and software to process data into accounting information, and then be able to actually communicate with people who need the accounting information. Accountants generally are classified as private or public accountants. A public accountant works on a fee basis for clients and may be self-employed or be the employee of a firm. Typically, public accounting firms include on their staff at least one certified public accountant, otherwise known as a CPA, an individual who has met the state requirements for accounting education and experience and has passed a rigorous accounting examination. Financial data are transformed into financial information and reported on three very important financial statements: the balance sheet, the income statement, and the statement of cash flows. So we're going to take a look at the balance sheet first. The accounting equation shows the relationship between the firm's assets, their liability, and the owner's equity. So assets are resources the business owns. This could be cash, inventory, equipment, real estate. Liabilities are the firm's debts. It's what they owe to other people. Owner's equity is the difference between total assets and total liabilities. What would be left over for the owners if the firm's assets were sold and the money was all used to pay off the firm's liabilities? The relationship between assets, liabilities, and owner's equity is shown by the accounting equation. Assets equals liabilities plus owner's equity. This is the basis for the accounting process. To use this equation, a firm's accountant must record raw data, a firm's day-to-day financial transactions using the double entry bookkeeping method. And this is a system of which each financial transaction is recorded in two separate entries to maintain the balance shown in the accounting equation. At the end of each specific accounting period, the financial transactions are summarized in the firm's financial statements, and information is presented in a standardized format to make the statements as accessible as possible to the various people that might be using them. A firm's financial statements are prepared at least once a year and include the firm's annual report. This is a report that's distributed to stockholders and other interested parties that describes a firm's operating activities and its financial condition. Most firms have a financial statement prepared semi-annually, quarterly, or monthly. A balance sheet, sometimes referred to as the statement of financial position, is a summary of the dollar amounts of a firm's assets, liabilities, and owner's equity accounts at the end of a specific accounting period. The balance sheet must demonstrate that assets are equal to liabilities plus the owner's equity, and the accounting equation is still in balance. Most people think of a balance sheet as a statement that reports the financial conditions of a business firm, but balance sheets apply to individuals too. Figure 15.5, which was on the last page that we were on right here, actually shows Marty Campbell's current personal balance sheet. So this is a balance sheet for a particular individual. The next figure that we see here shows the balance sheet for a company, and in this case, it's Northeast Art Supply Company. On a balance sheet, assets are listed in order from the most liquid to the least liquid. The liquidity of an asset is the ease at which it can be actually converted into cash for the company. You have current assets, and these are assets that can be converted quickly into cash or that will be used in 1 year or less. Because cash is the most liquid asset, it is always listed first. Next are marketable securities, your stocks, your bonds, your other investments that can easily be converted into cash in just a matter of days. Next to the firm's receivables, its accounts receivable, which results from allowing customers to make credit purchases, are generally paid within 30 to 60 days. However, the firm expects that some of these debts will not be collected. Thus, it has reduced its accounts receivable by a 5% allowance to equate for those doubtful accounts. The firm's notes receivable are receivables for which customers have signed promissory notes. They are generally repaid over a longer period of time than accounts receivable. Then you have merchandise inventory, and that represents the values of goods on hand for the sale to customers. Prepaid expenses are assets that have been paid in advance but have not been yet used. As shown in this figure, current assets actually equals $182,000. So right here, if you follow my little cursor, total current assets, and here you have that $182,000. Fixed assets are assets that will be held or used for a period of longer than a year. Fixed assets generally include land, building, and equipment. Note that the value of Northeast delivery equipment and furniture and the store equipment are decreased by their accumulated depreciation. So that's actually listed right here as well if you follow my cursor. Depreciation is the process of apportioning the cost of a fixed asset over its useful life. The depreciation amount allotted to each year is an expense for that year, and the value of the asset must be reduced by the amount of the depreciation expense. For Northeast Art, the fixed assets total $137,000. So there you have it right there. Intangible assets do not exist physically, but have a value-based or rights or privileges they confer on a firm. These will include patents, copyrights, trademarks, franchises, and goodwill. Intangible assets are considered long-term assets. They are of value to the firm for a number of years. For Northeast Art, the intangible assets total $21,000, which is this number right here. So your total assets would be your current assets plus your fixed assets plus any total intangible assets. So right here we see that the total assets for Northeast Art are $340,000. Next, you go to the other side of the balance sheet, the liability side. So the firm's liabilities are separated into two different categories. You have current and long-term liabilities. Current liabilities are debts that will be repaid within a year. Accounts payable are short-term obligations that arise as a result of making credit purchases. So usually when you do your billing, you're 30 to 60 days out. Notes payable are obligations that have been secured with promissory notes. Only those that must be paid within the year are actually listed under current liabilities. Northeast Art also lists salaries payable and taxes payable as current liabilities. These are both expenses that have been incurred during the current accounting period, but will be paid out in the next accounting period. For Northeast Art, current liabilities equals $70,000. When you go to long-term liabilities, these are debts that need not be repaid for at least a year. So Northeast lists only one long-term liability, and that is a $40,000 mortgage payment for store equipment. As you can see in figure 15.6, this figure that we're looking at right here, Northeast current and long-term liabilities total $110,000. So for a sole proprietorship or partnership, the owner's equity is the difference between your assets and your liabilities. For a corporation, the owner's equity, which is sometimes referred to as stockholders' equity, is the total value of stock plus retained earnings that have accumulated to date. Your retained earnings are the portion of a business profits that are not distributed to the stockholders. The original investment by the owners of Northeast Art Supply was $150,000, which is shown right here. In addition, $80,000 of their earnings have been reinvested into the business since it was founded. So retained earnings is listed right here. Thus, owner's equity equals $230,000. As the two grand totals in this figure show, Northeast assets and the sum of its liabilities are equal to the same amount. So look here on the bottom here. Your assets are going to equal your liabilities, and that's why it is known as a balance sheet. An income statement is a summary of a firm's revenues and expenses during a specific accounting period. The income statement is sometimes called an earnings statement or the statement of income and expenses. If you look at this first figure, it is showing a personal income statement for a person named Marty Campbell. Although the difference between the income and expenses is referred to as profit or losses for a business, it is normally referred to as a cash surplus or a cash deficit for an individual. It is also possible to use information from a personal income statement to construct a personal budget, a specific plan for spending your income. If we go over here to this one, it shows the income statement for the Northeast Art Supply Company. For a business, revenues less cost of goods sold, less operating expenses equals your net income. Revenues are the dollar amounts earned by a firm from selling goods, providing services, or performing its business activities. The gross sales, which is up here at the top, are the total dollar amount earned by the total dollar amount of all goods and services sold during this accounting period. So when we look at the accounting period, if I move myself real quick, we are looking at 1 year is our accounting period. Deductions are made from this amount. So you have your gross sales, and then we're actually going to deduct our sales returns. So these were merchandise that was actually returned to us by the customers. Our sales allowances, which is price reductions offered to the customers for maybe damaged or soiled merchandise. Sales discounts, which are price reductions offered to customers who pay their bills promptly. The remainder of what you have left is the firm's net sales. And this is the actual dollar amount received by the firm for the goods and services it has sold after the adjustment for returns, allowances, and discounts. For Northeast Art, net sales is $451,000. The standard method of determining cost of goods sold by retailing or wholesaling firms during an accounting period is summarized as follows. Your cost of goods sold equals your beginning inventory plus your net purchases minus your ending inventory. So in this case, Northeast Art Supply began its accounting period with merchandise inventory of $40,000. So that's what you're looking at right there. It then went on to purchase merchandise that was valued at $346,000. And then it deducted its discounts off of that. So it actually only paid $335,000 for its purchases. Thus, during the year, it had a total of goods available for sale valued at $40,000 plus $335,000 for a total of $375,000. Now, 12 months later, Northeast had sold all but $41,000 worth of the available goods. The cost of goods sold was therefore $375,000, which is right there, less the ending inventory that they still had on hand, which was $41,000, to give them $334,000, which is right there. A firm's gross profit is net sales minus the cost of goods sold. So in this case, you're taking $451,000 minus your cost of goods sold to give you a gross profit of $117,000. A firm's operating expenses are all business costs other than the cost of your goods sold. They are generally divided into two categories. You have selling expenses or general expenses. Selling expenses are costs related to a firm's marketing activities. And for Northeast, selling expenses totaled $37,000. So right here, you look at what the salaries, the advertising, sales promotion, depreciation, all that equals $37,000. General expenses are costs incurred in managing the business. For Northeast, the general expenses, so when we look at salaries and rent, furniture, utilities, it's going to equal $42,500. Net income, so when your revenues exceed your expenses, the difference is actually called a net income. When expenses exceed revenues, the difference is called a net loss. Northeast net income from operations is computed as your gross profit on sales, which is your $117,000, which is right here, less your total operating expenses, which was $79,000 right there. For this, the net income then you can see is $37,500. Interest expense of $2,000 is then deducted off of this from net income to attain net income before taxes. So your net income before taxes, I lost my cursor there, is $35,500. The interest is deducted in this section of the income statement because it's not an operating expense. Rather, it's an expense that results from actually financing the business. Northeast's federal income taxes are listed right here at $5,325. Although these taxes may or may not be payable immediately, they are an expense that must be deducted from the income. So this actually leaves Northeast with a net income of $30,175. This amount may be used to pay a dividend to your stockholders, retain or reinvested by the firm, or used to reduce the firm's debt, or possibly all three. Next, we're going to look at the statement of cash flows. This illustrates how the operating, investing, and financing activities of a company affect cash during an accounting period. The statement of cash flows focuses on how much cash is on hand to pay the firm's bills. A statement of cash flows for Northeast Art Supply is illustrated in this graphic right here. The cash flow statement is organized around three different types of activities. You have operating, investing, and financing. Cash flows from operating activities. So this is the first section, and it addresses, it's the first section right here, and it's going to address the firm's primary revenue sources. So providing goods and services. Typical adjustments include adding the amount of depreciation to a firm's net income. Other adjustments for increase or decrease in the amounts for accounts receivable, inventory, accounts payable, and income taxes payable are also required to reflect a true picture of the cash flows from the operating activities. Cash flows from investing activities is the next section down. So if you go to the next bolded section down, it's here. And this is concerned with cash flow from investments. This includes the purchase and sale of land, equipment, and other long-term assets or investments. And then you have cash flow from financing activities. And this deals with cash flow from all financing activities. It reports changes in debt obligation and owner's equity accounts. The total of all three of these activities are added to the beginning cash balance to determine the ending cash balance. Together, the statement of cash flows, balance sheet, and income statements illustrate the results of past business decisions to reflect the firm's ability to actually pay their debts and dividends and finance new growth. To evaluate a firm's financial health, often the first step is to compare the firm's financial data with other firms in similar industries and with its own financial results over a recent accounting period. You will have the opportunity to do this extensively in your financial management class. Many firms compare their financial data with those of competing firms and with industry averages. So comparisons are possible as long as accountants all follow, remember those same rules, those GAAP rules. Comparisons among firms give executives, managers, and employers a general idea of how the firm's relative effectiveness is and its standing within the industry. Competitors' financial statements can be obtained from their annual reports if they are a public corporation. Industry averages are published by reporting services such as, it's called DNB, formerly known as Dun & Bradstreet, as well as by some industry trade associations. Today, most corporations include their annual reports, comparisons of important elements in their financial statements. A lot of times you're able to actually get this information directly off an industry's firm's website, or you will be doing an activity next week where we will show you how Newman has a database where you are able actually to retrieve some of this stuff as well. So next we're going to go to financial ratios. So a financial ratio is a number that shows the relationship between two elements of a firm's financial statements. Like the individual elements in a financial statement, these ratios can be compared with those of competitors, with the industry average, and with the firm's past ratios from previous accounting periods. So measuring a firm's ability to earn profits. A firm's net income after taxes indicates whether the firm is profitable. It does not, however, indicate how effective the firm's resources are being used. For this purpose, a return on sales ratio can be computed. So a return on sales ratio, or otherwise known as the profit margin, is a financial ratio that's calculated by dividing the net income after taxes by your net sales. It indicates how effectively a firm is transforming sales into profits. A higher return on sales is better than a lower one. Today, the average return on sales for all business firms is usually between 4 and 5%. A low return on sales can be increased by reducing expenses and increasing sales. Next, we're going to look at how how we measure the firm's ability to actually pay its debt. So the ratio that is used here is the current ratio. It is computed by dividing current assets by current liabilities. So the average current ratio for industries is 2.0, but it varies greatly from industry to industry. A high current ratio indicates that a firm can pay its current liabilities. A low current ratio can be improved by repaying current liabilities, by reducing dividend payments to stockholders, to increase the firm's cash balance, or by attaining additional cash from investors. Measuring how well a firm manages its inventory. A firm's inventory turnover is the number of times the firm sells its merchandise inventory in 1 year. It's approximated by dividing the cost of goods sold in 1 year by the average value of the inventory. The average value of the inventory can be found by adding the beginning inventory value and the ending inventory values and dividing the sum by 2. The average inventory turnover for all firms is about 9 times a year, but turnover rates vary widely from industry to industry. The quickest way to improve inventory turnover is to order merchandise in smaller quantities at more frequent intervals. We're also going to look at the return on owner's equity So this actually measures the return on a stockholder or owner's investment. When you invest or you own a business, you expect to earn a return on the money that has been put into this business. And this ratio basically tells you how well you are doing in the accounting sense. So return on owner's equity, also known as ROE, is the net income divided by the owner's equity. There are a few things that you have to watch out for when you're using this particular ratio, because although ROE is an important measure of performance, we know that managers strive always to maximize shareholder wealth. If a firm takes steps that improve its ROE, does that mean that the shareholders' wealth will also be increased? The answer is not necessarily. Indeed, three problems are likely to arise if a firm relies too heavily on ROE to measure its own performance. First, ROE does not consider risk. So shareholders can care about ROE, but they also care about risk. Second, ROE does not consider the amount of invested capital. To illustrate this, a company that is choosing between two mutually exclusive projects, let's say one project calls for investing $50,000 and you expect an ROE of 50%, while the other is investing $1 million at an ROE of 45%. The projects are equally as risky and the company's cost of capital is 10%. Project A will actually have a higher ROE, but it is much smaller. Project B should then be chosen because it would add more to a shareholder's wealth. So there's many things that you need to consider when you're looking at ROE. And third, ROE can actually cause managers to turn down profitable projects. For example, suppose you manage a division of a large firm and the firm determines bonuses solely on the basis of ROE. You project that your division's ROE for the year will be an impressive 45%. Now you have the opportunity to invest in a large, low-risk project with an estimated ROE of 35%, which is well above the threshold of that 10% that the firm has set for its capital. Even though this project is extremely profitable, you might be reluctant to undertake it because it would reduce your own division's ROE and therefore reducing your own end of the year bonuses. So those are just some potential things to think about when you look at ROE. You're going to actually have an assignment this week about a nursery where you're going to have to calculate the ROE as well as some other of the financial calculations that are ratios that were provided in this. And it's just to give you guys a general understanding of what do we use these calculations for? What do they help us understand about our business? And if our business is not performing as well as we would like it to, what can we do to stop that? So that's something that you can look forward to next week.